In 2005, in a small office in San Jose, California, a man with one glass eye sat alone reading documents that almost nobody else in the world was reading. He was a doctor by training, a neurologist who barely talked to anyone. He had Asperger's. He worked at night, in flip-flops and a t-shirt, listening to heavy metal at full volume. And in those documents, he saw something that would soon shake the entire world economy. He saw that millions of American homes had been sold to families who could never, ever pay them back. That the biggest banks on Wall Street had stacked those loans into towers of paper that they were selling to each other as if they were gold, and that the whole pyramid was about to collapse. He told his investors. They laughed. He told the banks. They laughed harder. He kept saying it for 2 years, while everyone around him called him crazy. Then 2008 happened, the biggest financial crash since the Great Depression. Millions of people lost their homes. Trillions of dollars vanished from the global economy. And that one quiet doctor, sitting in his small office in San Jose, walked away with $725 million in profit. This is the story of how one man saw the biggest crash in modern history before any expert, any bank, or any government did, and how he made a fortune from being the only one in the room who was willing to say the obvious thing out loud. Let's begin. His name is Michael Burry. If that sounds familiar, it's because Christian Bale played him in The Big Short. The guy in flip-flops, drumming on his desk, talking to the wall. That part of the movie? Not exaggerated. That's actually how he worked. But before he was a hedge fund manager, Burry was a medical doctor. He went to UCLA, then to Vanderbilt, then started his residency in neurology at Stanford. He had a glass eye from a childhood tumor. He had been diagnosed with Asperger's, and he found it almost impossible to make small talk with patients. So in his free time at night, in the hospital, instead of sleeping, he wrote a blog about stocks, just for fun, about what he was reading, about what didn't make sense in financial reports. And here is the part nobody tells you. That blog was so good that hedge fund managers, professional investors, the kind of people who manage billions of dollars, started reading it in secret. They quoted him. They asked who this guy was. They had no idea he was a tired 30-year-old neurology resident, writing in scrubs at 3 in the morning, listening to Pantera on full volume. In 2000, he finally left medicine, took the small savings he had, and opened a tiny hedge fund called Scion Capital. One person, one office, his own family money, about $1 million in total. By 2005, that small fund had grown to over $600 million under management, almost all of it from outside investors who had read his blog. And then, sometime in 2005, Burry started reading something that almost nobody else on Wall Street was bothering to read. The actual mortgages. The boring 300-page documents nobody opens, page by page, loan by loan. And the deeper he read, the more his stomach turned. To understand what he saw, you don't need to be a finance expert. You just need one simple picture. Imagine a neighborhood, 200 houses, all on one street. In a normal year, the people in these houses earn salaries, pay their mortgages, and life goes on. Boring. Safe. Now imagine that in this neighborhood, something strange starts happening around 2003. The banks start handing out mortgages to absolutely everybody. To people with no job, to people with no income, to people who already had 3 failed loans, to people who literally couldn't sign their own name. In the United States, these were called subprime mortgages. They were marketed as, "Don't worry about your salary, the house will pay you back when its price goes up." And for a while, it worked. House prices kept climbing. People bought houses they couldn't afford. The houses went up in value, and on paper, everyone was rich. But here's the part nobody talks about. These mortgages were not staying with the local bank. They were being bundled up by the thousands, packaged into financial products called mortgage-backed securities, and sold all the way up to Wall Street. Pension funds, insurance companies, foreign governments, everyone was buying. And to make it even more confusing, Wall Street took those bundles, mixed them with other bundles, sliced them, repackaged them, and gave them stamps of approval that said, safe as gold. AAA rated. Same rating as a U.S. government bond. Burry read what was actually inside those bundles, and it was junk. Loans to people who had no way of paying. Loans where the first repayment hadn't even been made yet. Loans where the names didn't match anything real. In simple terms, the banks were taking poison, putting it inside boxes labeled organic chocolate, and selling those boxes to the entire world. And Burry was the only one bothering to open the box. So Burry sat in his office and asked himself a strange question. What if I could bet against this entire pile? What if I could buy a kind of insurance on a building that I knew was already on fire? Let me explain this with a story you'll never forget. Imagine that you live in a neighborhood, and one day you notice that half the houses on your street are quietly catching fire. Smoke coming out of the windows, smell of burning wood. But nobody else seems to see it. The kids are playing in the gardens. The neighbors are watering the lawns. Life looks normal. Now imagine that the local insurance company will sell you a fire insurance policy on your neighbor's house. Not your own, your neighbor's. If the house burns down, you get paid. The price of the policy is tiny because the insurance company doesn't believe the house is going to burn at all. So you walk in very politely and you ask for fire insurance on 100 different houses in the neighborhood. The insurance agent looks at you, raises an eyebrow, charges you a small fee, and signs the papers. In his head, he is thinking, this guy is wasting his money. None of these houses are going to burn. That, in plain English, is what Michael Burry did in 2005. The official name for this insurance was a credit default swap. The thing being insured wasn't a house. It was the giant bundle of subprime mortgages. And the insurance company wasn't a normal one. It was Wall Street itself, primarily a giant called AIG. Burry walked into the biggest banks in the world and asked, "Can I buy insurance against these mortgage bundles defaulting?" The bankers smiled. They thought he was an idiot. They charged him almost nothing for the premiums because they were convinced these bundles would never, ever fail. They were rated AAA, remember? Safe as gold. In total, between 2005 and 2007, Burry spent about $1.3 billion of his fund's money buying these insurance policies. $1.3 billion, betting that the safest assets in the entire world were actually about to explode. Now here's the part nobody talks about, the part the movie shows, but most people forget. From the moment Burry bought those policies in 2005, he was wrong for 2 full years. The American housing market kept climbing. House prices went up another 20%. The bundles he had bet against kept being rated AAA. The insurance premiums he was paying every month just bled his fund, dollar by dollar. His investors started panicking. They had given him their money to invest in stocks, and instead he was paying premiums on something called credit default swaps that nobody understood. They demanded their money back. Some of them sent him angry emails. Some of them sued. Burry, at this point, was sitting in his office, almost alone, with the entire world telling him he was wrong. His own investors, the biggest banks, government economists, the rating agencies, everyone was saying the same thing. The housing market is fine. You're overreacting. Sell the swaps. He didn't. He doubled down. He kept buying more. And here's the part I think about, honestly, more than I probably should. In one of his letters to investors in early 2007, Burry wrote something like, "I am right, I am alone, and I am being punished for being right too early." That sentence, to me, captures everything about what's actually hard in life. It is not hard to be right. It's not even that hard to be right alone. What is hard is to be right alone, for months and months, while everybody you respect tells you you're an idiot. Then, in the spring of 2007, the smoke started showing through the windows. The first big subprime lenders started going bankrupt. Bear Stearns had to bail out 2 of its own hedge funds because of mortgage bonds. The cracks were no longer invisible. By the summer of 2008, the houses on the street were openly on fire, and the insurance company, AIG, the giant that had sold Burry those policies, suddenly realized that it owed tens of billions of dollars to the only person who had been right the whole time. When the collapse finally came, in September 2008, the numbers were almost cartoonish. Lehman Brothers, a 150-year-old bank, went bankrupt in a weekend. The U.S. government took over AIG to stop it from imploding. Stock markets around the world lost 40% of their value. Millions of Americans lost their homes. And in his tiny office in San Jose, Michael Burry's screens started flashing green. The insurance policies he had bought for almost nothing were suddenly worth a fortune. The very same banks that had laughed at him in 2005 were now scrambling to pay him. His fund's total profit on the trade was about $725 million, $750 million, from one man with a glass eye and Asperger's who had simply read the documents that everyone else was too lazy to open. But here is the brutal twist. By the time the money arrived, almost all of his original investors had already pulled out. They had sued him, accused him of being reckless, and walked away from the trade before it paid off. Burry, the man who saved his own clients from total disaster, ended up earning the money for people who had quit on him. In late 2008, after years of stress, lawsuits, and public mockery, he wrote a final letter to his investors. He told them he was closing the fund, he thanked them politely, and he walked away from the industry. He didn't talk to the press. He didn't write a book. He didn't go on CNBC. He just went home. Then a few years later, in 2010, a journalist named Michael Lewis wrote a book called The Big Short, which told the story of Burry and a handful of other outsiders who had seen the same thing. In 2015, the film came out, and suddenly the quiet doctor with the glass eye was a household name. Bale won an Oscar nomination for playing him, but Burry himself was already gone again, reading documents nobody else was reading, looking for the next thing nobody wanted to see. So what's the actual lesson here? Because it's not go bet against the market. The truth is, 99 times out of 100, betting against the crowd will destroy you. Most people who try to be the next Michael Burry just end up losing their savings and feeling smart for 10 minutes before reality crushes them. The real lesson is something much quieter. It's about what you're willing to look at when nobody else is looking. In 2005, the documents about subprime mortgages were public. Anyone with internet and a couple of evenings could have read them. The data was there. The story was there. The collapse was, in hindsight, hiding in plain sight. What separated Burry from the other 10 million people who could have seen it was that he was willing to sit alone with a thick, boring document in the middle of the night and ask, does this actually make sense? And once you see that, you start seeing it in a lot of places. The dot-com bubble in 1999, the crypto cycles, the AI valuations of 2025. Every couple of years, something massive gets a AAA stamp. Everyone agrees it's safe, and somewhere, in some tiny office, somebody is reading the fine print and slowly realizing, this is on fire. That's the trade. To see what nobody else wants to see, you have to be willing to be the only one in the room saying the obvious thing out loud, for years, before anyone admits you were right. So next time you hear that something is safe as gold, or that this time is different, or that the experts say everything is fine, don't trust the headlines. Open the document, read the fine print, and ask yourself the same question Burry asked in 2005. Does this actually make sense? Because the people who quietly answer no are usually the ones who, 10 years later, end up writing the history of what happened. If your brain feels a little rewired right now, good. That's the whole point of this channel. We dig into the hidden corners of money, and we make them make sense for anybody. So if you want more stories like this one, you know what to do. I'll see you in the next one. Take care.